Hello everyone, and a very warm welcome to this ICAS webinar, the first of our three-part series of our autumn tax updates. For those that don't know me, I'm David Mingus, Director of Practice here at ICAS, and it's my great pleasure to be your host for today's webinar. In this series, we're going to be providing an essential roundup of the most recent tax developments, including, of course, the most important announcements from the budget held most recently on the 30th of October. And of course, while there has been much that has been caught in the general headlines about the budget, there is, of course, a lot more detail behind the headlines, which we are going to try and unpack for you today. So in today's webinar, we're going to concentrate on the recent tax developments that impact particularly owner-managed businesses and those on employment taxes. And over the next 55 minutes or so, we will look to remind you of some of those key issues and look at some of the practical implications of changes in those areas. To explain and help us understand these issues, I'm delighted to be joined today by my colleagues Chris Campbell and Justine Ricomini. Chris is Head of Tax for Tax Practice and OMB Taxes here at ICAS. He's a Chartered Accountant and Chartered Tax Advisor and joined ICAS after a career in practice working with owner-managed businesses. He supports members mainly with technical queries, but also represents ICAS on various HMRC stakeholder groups. Justine is our head of devolved and employment taxes and also represents ICAS at several HMRC and industry forums, mainly in relation to employment and their related tax positions. Justine is a recognised expert in the field, known for bridging both practical experience and bringing a deep technical knowledge. Before we begin, just a few housekeeping matters to remind you of. You can, of course, submit questions at any time through the Q&A facility, which is accessible at the top of your screen. Do please put them in. We'll be answering those towards the end of the webinar. Questions can, of course, be submitted anonymously, so don't be concerned about making your name available. We'll pose them anonymously, but also you can join the conversation today through the chat box, which is also accessible at the top of your screen, and this allows you to comment or discuss with fellow attendees the matters that are covered by this webinar. While both those facilities should be available for virtually everyone, we are aware that occasionally, due to your own organisation's policies or the browsers you're joining for, sometimes one or both of those may not be available to you. So if that's the case, we can only apologise, but those are due to circumstances out of our control and to do with your own organisation's policies. Beyond that, we are, of course, recording this webinar and we'll be making it available for on-demand viewing afterwards. So either you can refer back to it or share it with colleagues. And as always, the slides will be available on the events page on the ICAS website under the event listing for you to look back at your leisure. So we do look forward to receiving your questions throughout the course of the webinar, and we'll try to get as many of those as possible. But I do know that both Justine and Chris have a huge amount to get through in the time that we've got. So without further ado, I'll just pass straight across to Justine. Justine.
Hello, thank you, David, for that amazing introduction. I need to live up to the pressure of that now. So let me just take control of the slides. There we go. So the topics for today that we want to run through, just to summarise them for you, are an employment taxes update which covers national insurance, vans, car definitions, and a lot more besides. And then we're moving on to the owner managed business section, where Chris will run through the taxes that are impacted by the autumn UK budget. So let's move on to the employment taxes section then. I've got a whole buffet of offerings for you today, as you can see on the slide. So I'm not going to go through that. You can see what's on it. Let's get on with the national insurance changes. So in the spring, I reported on the two sets of changes that have been made to reduce employees' national insurance. So we had one last autumn and then another one in January, and employees' national insurance went down by a fair old margin. But now I'm actually here to talk to you about the rise in employers' national insurance and a few other things besides, such as the lowering of the thresholds at which national insurance becomes payable and the revisions to the employment allowance. The government appear to have managed to make things sort of 3 times more complicated for employers to work out exactly what they're paying each year in national insurance. So it's important to get the forecasting and budgeting for this right. So payroll managers have got 6 months to work on this so that the rest of the business knows what the costs are going to be. The sting in the tail is that thresholds have actually been lowered at which employers' national insurance is due. And this in itself is actually probably more punitive than the rise in the rate because it brings a lot more employees into the scope of secondary national insurance. And it brings them in earlier. And remember, the rate is now charged at 15% as opposed to 13.8%. So employers UK-wide will now be paying national insurance on all earnings over £5,000 instead of £9,100 at 15% until the upper earnings threshold is reached of £50,270 when it drops to 2%, which equates to an additional £615 per annum per person just on the bit of the threshold that's been lowered, without taking into account the remaining earnings up to the upper earnings threshold, where there's an extra 1.2% to pay. So the lowering of the threshold is in itself, quite an astonishing change. Although this was heralded by the UK government as a budget which will not affect the working man on the street, I can't help agreeing with the CIPD, who've expressed concern that this may be likely to stifle wage growth, recruitment, and may promote headcount reductions if employers are not just not making the profits margins that they need to fund the additional costs. So we'll have to wait and see whether these measures do in fact have a trickle-down effect on the working man on the street. And just a final point on this slide, it does remain to be seen what the Scottish Government will now choose to do with income tax rates and bands in Scotland in their budget on the 4th of December, which we'll be doing a webinar on the 12th of December. And, we already have a primary national insurance anomaly there with the so-called middle income band of workers whose earnings fall between £43,663 and the current UK NI upper earnings threshold of £50,270, where the employees pay Scottish higher rate income tax of 42% and still has to pay national insurance of 8% on that £6,607 difference. So that's 50% in total on that bit of their earnings. And their UK counterparts are paying basic rate income tax on the same earnings at 20%. So they pay 28% on that bit. Of course, employers in Scotland will be just as harshly affected as the rest of their UK counterparts on the national insurance front at the moment as a result of this budget, because national insurance is, of course, a reserved matter. It's not devolved to Scotland. So I'll just move on to the next slide, which is the employment allowance measures. So the rise has taken place from £5,000 of an employment allowance per employer to £10,500. In the autumn 2024 budget, the changes to the employment allowance £100,000 limit on the previous year's combined payrolls national insurance liability threshold leads me to think that there's a possibility that from the 6th of April 2025, employers will no longer need to consider either state aid or subsidy control rules. If that's the case, then given the lowering of the secondary NIC's threshold to £5,000 from £9,100, the rise in employment allowance is a welcome incentive. But let's not get too carried away, because the additional national insurance which employers will have to pay from the 6th of April next year far outweighs this allowance. The Chancellor suggested it would fund additional jobs in her speech, but given the rise in national living and minimum wage rates and the rise in employer national insurance, the employment allowance is likely to get swallowed up by that rather than give employers a new opportunity to recruit. HMRC's guidance on employment allowance says check if you're eligible, the guidance on checking whether you're eligible to claim the employment allowance makes reference to state aid provisions still, in particular for electrical supply wholesalers in Northern Ireland, but it doesn't mention subsidy control. So there's an obvious risk associated with the rise in employment allowance anyway, and that has already been pointed out to the government, which is the increased incentive for the formation of so-called mini umbrella companies, which have presented HMRC with a real headache in terms of fraudulent claims of employment allowance and flat rate scheme VAT in the past. So I've posed the question to the policy team about whether employment allowance is still classified as state aid, and we're awaiting a response on that, which I'll publish in due course. So just a note on employment allowance. Public bodies or businesses who carry out over half their trade with public sector bodies, such as local councils and NHS services, can't claim the employment allowance unless they're a registered charity. And companies with just one director, where that director is the only employee liable for secondary Class 1 national insurance, can't claim employment allowance either. And certain employees can't be included in a claim, such as someone whose earnings are within the off-payroll working rules and someone that you might employ for personal household or domestic work, such as a nanny or a gardener, unless they are actually qualifying to be a care or support worker. Excuse me. So I'll move on from there and talk about the national minimum wage. UK government has announced that it's accepted the Low Pay Commission's recommendations for national minimum wage and national living wage rates set to come into effect from the 1st of April 2025. So the new rates reflect considerable increases, as you can see on the slide, with the government citing the aim of supporting low-paid workers against rising living costs and bringing the national living wage closer to 2/3 of median earnings, meeting the government's targets. This is the first time the Low Pay Commission has been specifically tasked with considering the cost of living and future inflation trends in its recommendations, which is actually a good thing. The Low Pay Commission's proposals, which include insights from the Office of National Statistics and economic projections from the Bank of England, are intended to ensure that real-term wage growth and the shielding of low-paid workers from inflationary pressures is a priority up until March 2026. Now, I've mentioned on here about the living accommodation offset. This can be a little bit confusing, but essentially it's an amount which is deemed to be included in an employee's pay if their wages are below national minimum wage, but if they live in rent-free accommodation, and that value counts towards the national living or minimum wage. And another point on here is that a full-time equivalent role, now that we have these new national minimum and living wage rate rises, a full-time equivalent role of 30 hours a week would now cost an employer about £427.35 or £22,220.20 per annum, plus pension contributions. So let's say 3% employer contribution might be around £660, and 15% secondary national insurance on the earnings over 5,000, which comes to around £2,500. So it's clear that to employ someone nowadays, the employer needs to generate around about 25,500 of income just to break even to be able to pay a 21-plus-year-old the national living wage. So I'll move on from that to van and car definitions from the 6th of April. You may remember back in the spring we were talking about this matter in terms of car and van definitions as a result of the Coca-Cola case, and HMRC changed its guidance in February 2024 and then had to change it back 12 days later due to various protestations that were being made by the professional bodies and other bodies such as the NFU. But in this budget, the sting in the tail came when the government decided that from the 6th of April 2025, HMRC will no longer be aligning the car and van definitions for benefit in kind purposes with the VAT definitions, which gives them the freedom to do something different. And within that scope, most double cab pickups will, from the 6th of April 2025, be classified as cars for benefit in kind charges, which is a substantial increase. I mean, if we know how much a double cab pickup costs these days, it's significant in comparison to the van benefit in kind charge. So transitional arrangements will apply for any vehicles purchased, leased or ordered before this date, and maintaining the previous treatment of a van benefit in kind until the earlier of their disposal, lease expiry, or the 5th of April 2029, whichever comes first. So that's what I think all the protestations have been about this week down at Westminster and in other places. So I'll move on to company cars benefit in kind charges, which have been changed in this budget. Company car tax rates are set to increase by 2% for zero emission vehicles. At the moment they are 2%, so they'll be going up to 4% from 2028-9 and 29-30. That will be the value of the benefit in kind charge. And any vehicles with CO2 emissions in the next category up, which is 1 gram to 50 grams per kilometre of CO2, will have the appropriate percentages of 18% in 2028-29 and 19% in 2029-30. And all the other emission bands on the tables will increase by 1 percentage point per year in 2028-9 and 29-30 to a maximum of 38% for 28-29 and 39% for 29-30. So we can see things moving there. The electric cars, low, no emission vehicles charges are starting to creep up. And the incentive, presumably, there is for people to move to those cars eventually over time as things progress. But of course, the tax charge has to come from somewhere on company cars. So the zero emission cars will eventually creep up the scale, just as they have done with combustion engine vehicles. So in terms of payrolling of benefits in kind, just a little update here. We know that payrolling of benefits in kind is definitely going ahead from 2026, April 2026. Loans and accommodation, which are the two difficult ones where the legislation isn't really fit for purpose to actually translate into a payrolling of benefits in kind matter, will follow later on. We don't know when, but they will follow later. And I'm hoping that, as usual, ICAS will be at the table with the other professional bodies and institutes to actually work on the detail of how to work out the payrolling of benefits on loans and accommodation. And we'll also be helping HMRC formulate guidance on that as well. So I'll just touch on apprenticeship levy changes then. The apprenticeship levy is going to be transformed, apparently. Not just changed a little bit, completely transformed, which actually might be a good thing, because at the moment there's been historically, since apprenticeship levy was brought in, very low take up, lots of confusion, lots of different types of arrangements in place, because also apprenticeship levy is a devolved matter. So in Scotland, it's dealt with differently to England and Wales, and Northern Ireland could make its own regime as well at some point. So it would be good if some of these regimes were being better aligned and actually, helping employers to fund apprenticeships. So we'll see what those measures contain. And once again, ICAS will be working with HMRC on those changes and the guidance. And let's hope that in future the apprenticeship levy is better used and meets the needs of employers. So I'll just touch now on umbrella company PAYE transfers. If you or your clients are involved with umbrella companies, it's important to know that from April 2026, the legislation is being put in place which will shift the pay-as-you-earn responsibility from the umbrella companies to recruitment agencies who are in the labour supply chain. So once again, as ever with umbrella companies, it's very, very important to make sure that everybody in the labour supply chain is aware of where they sit in that chain. If no agency is actually involved in the chain, the end client becomes responsible for the pay-as-you-earn. So clearly, record keeping is, as ever, paramount. Robust processes, audit trails, etc. are needed to make sure that everybody can prove that it's either them that's liable or them that is not liable for the pay-as-you-earn. So I'll just move on to section 690A requests here. So this is to do with internationally mobile employees. If you have any of those people as clients, or as your client employer is actually employing internationally mobile workers, there is a bit of legislation which will help slightly with the simplification of requests. Employers can inform HMRC of any non-pay-as-you-earn amounts and the calculations to go with them, and then just proceed to implement them without actually waiting for HMRC to confirm the position. It's a very welcome simplification. Unfortunately, it does come hand in hand with the news that the Expat Forum, which is a subsidiary of the Employment and Payroll Group Forum, which I co-chair, has been closed down. It does mean that policy discussions on expatriate tax matters can no longer happen at the moment. But I am hoping that over the next few months we will see a different sort of forum emerge from the ashes. But I'm not able to update on that at this particular point in time. So I shall finish my bit now and hand over to Chris. Chris.
Thank you very much, Justine. Good afternoon, everyone. I hope wherever you're watching this webinar from, it's not too cold, and despite the frosty weather that's been gripping us over the last few days. So just to move on to what was in the autumn budget and the owner-managed business space, there's lots of things that have changed, and we'll come on to those in a moment, but there's quite a number of areas where actually things have not changed or won't be changing for some time. The first is the personal allowance. The previous government had announced that the personal allowance of 12,570 would be frozen until April 2028. So that's still going ahead. But Rachel Reeves in her budget did announce a plan to index that in line with the rate of inflation from 28-29 tax year onwards. The freezing of thresholds, though, does mean that the number of taxpayers paying more tax is going to increase because of the concept of fiscal drag, which you'll all be familiar with. There's been lots of talk about that in the media over the last few years as we've had an environment of frozen tax rates, frozen tax thresholds and personal allowance. So the UK income tax rates and bands aren't changing. It's important to bear in mind that those UK tax rates are relevant for Scottish taxpayers when it comes to their savings and dividend income. The Scottish budget in December will cover the non-savings, non-dividend income, and we'll watch that space closely. And our webinar in December will cover that in more detail once we know what those changes are. But sticking with the UK budget for now, the dividend allowance reduced. It used to be £5,000, and it's reduced over the last few years down to £500. That's still going to remain in place. There's no changes to the dividend tax rate, so they remain unchanged at 8.75% for basic rate, 33.75% for higher rate, and 39.35% for UK additional rate taxpayers. The corporation tax rates, we'll cover that in more detail in a minute, but the headline rates of 25% for the full rate and the small profits rate of 19% will remain unchanged for the next few years. And capital gains tax annual exemption, you will all remember how this used to be in excess of £12,000, and Jeremy Hunt, when he was Chancellor, brought this down to £3,000. It's still £3,000 and no plans to change it or increase it in any way in the next few years. So more people will end up paying capital gains tax than might have previously been. On corporation tax matters, on Budget Day, the government announced the publication of the Corporate Tax Roadmap. Now, that was intended to be an ambitious plan. I don't think there's anything too ambitious in it. I think it's the initial reaction from businesses and agents that I'm speaking to, our members that I'm speaking to, don't think there's anything too ambitious there, but there is a commitment to maintain the 25% corporation tax rate and the 19% small profits rate for this Parliament. There are no changes to the corporation tax thresholds for those rates or the marginal relief that will apply for those companies that are between the two thresholds. We spoke about that in quite some detail in previous webinars when the rates came in, because there was a big jump in the last couple of years in the corporation tax rates when the 25% came into play. So no changes to that. No changes to the R&D relief rates on patent box. There's still a commitment to incentivising companies to invest in R&D and into developing paying expenditure that's in respect of patents. What the roadmap did cover is a commitment for a new process for advanced assurance for major projects. This is more for the larger end of the corporate tax space, because larger companies might be doing things that are more complicated and require some form of advanced assurance in terms of the viability of them going ahead. There's also an announcement in terms of trying to make efforts to simplify and improve the tax administration. There's some consultations in the pipeline, and ICAS will be engaging with those as and when they come out. On capital allowances, full expensing on new and unused plant and machinery by companies will continue. We had hoped that there may have been a move away from it just being new and unused plant and machinery, but there is no change to that. So for companies, there's still incentive to get 100% relief on qualifying plant and machinery additions. The government is exploring whether that can be extended to assets bought for leasing or hire. No timescale for that. It's just when they determine that the fiscal conditions allow them to do so. What is continuing, however, is the £1 million annual investment allowance for companies, it's for unincorporated businesses as well. And the important distinction on that one is it's not restricted to the new and unused requirement of the full expensing regime. There's no increase to the £1 million threshold, but the government has previously stated that that generally covers all the qualifying additions for upwards of 95% of businesses. Businesses which are partnerships that are not all individuals don't qualify for the annual investment allowance. There's some articles on icas.com which give more details on that if you need it, or also happy to answer any questions that you have by getting in touch with us. Also in the capital allowances front, the first year allowances for zero emission cars and electric vehicle charge points, it's a temporary allowance at the moment, and that's been extended to 31st March 2026 for corporation tax purposes, and the 5th of April 2026 for income tax. There's more clarity promised in the budget on areas of uncertainty. I haven't got any information as to what that is. One area which it would be great if we could get some more clarity on more generally is when a vehicle is a car or when a vehicle should be treated as a commercial vehicle. It would be great if you could type in a car registration number into a website in the same way that you can check the vehicle tax position of a car or any vehicle, as for that matter of fact. That's what I would really like to see. I'll never say never, but you never know whether that type of thing is what is promised in the way of clarity, because there is a big difference between the tax treatment, not just for the reasons that Justine outlined a minute ago, when it comes to the benefit in kind position, because company cars and company vans are taxed differently for benefit in kind purposes, but also from a capital allowances point of view too. And that moves nicely on to revisiting the double cab pickup position. Now, Justine touched on this earlier when it comes to the benefit in kind process. There's all change again on the capital allowances front. So the HMRC guidance, we had the new guidance in the start of the year, and then within 2 weeks it was revised again following the reaction from the farming sector and others, and it was agreed to park that. It was always an expectation that the double cab decision would be revisited at some point. What I suspected might have been the case was that there might have been a recognition of where those businesses use the double cabs for their business, such as the farming and fishing sectors. But what the government has decided to do is to go ahead with the original plan to treat double cab pickups with a payload of 1 tonne or more as cars. Now, instead of it being from July, as the original plan was, it's going to be from 1st April 2025 for corporation tax purposes, and the 6th of April 2025 for income tax purposes. But the existing capital allowances treatment will apply where the double cab is purchased before that date. So I would be expecting a flurry of activity by those businesses which are looking to purchase a double cab pickup for business purposes, for providing to their employees, and mainly because there's that commitment that you can carry on to claim capital allowances where the double cab pickup has been purchased before April 2025. But after April 2025, it's going to make a huge difference. So if you think about what Justine said earlier in terms of the car benefit and how that is different to the van benefit rules, but for capital allowances point of view, there's no annual investment allowance or full expensing on cars. So you're going from a situation that your double cab pickup will have previously been eligible for 100% capital allowances, and that will then become down to most likely 6% writing down allowances going forward. So there's a big difference in the tax relief available for the company, for the business, for those double cab pickups for capital allowances point of view. Moving away from capital allowances but on to capital gains tax changes, lots of things to report here. The main capital gains tax rate increasing to 18% and 24% from budget day. So those transactions on or after budget day, an immediate change to the capital gains tax position. And this aligns the rates of capital gains tax to the existing rates for residential properties. So in a way, it is a simplification to some degree, but it's only that is a fact, but it's not necessarily simplification in the way that people might want to, because it's a moving of the lower rate up rather than the upper rate down. So 18% and 24%, that's taking effect straight away. And I'll not dwell too much on carried interest, but just to flag that the rate increased to 32%, or increases to 32% from 6th April 2025, before the carried interest regime moves to the income tax framework from the 6th of April 2026 onwards. So for those taxpayers that have got businesses, business assets, or say shares in a trading company that they've been operating, the change to business asset disposal relief is likely to affect them. Now, the first thing that didn't change was the lifetime limit for business asset disposal rate. That's been £1 million the last few years, so there's no increase in that, but it's £1 million on gains since 2008. So as time goes on, the number of people actually able to get business asset disposal relief is going to reduce. And the benefit of that relief is going to be less as well, because the rate of capital gains tax where the gain is covered by business asset disposal relief or investor relief is going to increase to 14% from 6th April 2025 and to 18% from 6th April 2026. So for higher rate taxpayers, there's not going to be a huge difference from 2026 in the rate of capital gains tax payable if the asset being sold is covered by business asset disposal relief or not, the gap being between 18% and 24%. So it may well be in the future that there'll be a further increase, or that business asset disposal relief and investor relief will decrease, will just disappear in some form. Investor relief had a higher lifetime limit, and that reduced on budget day to £1 million as well. So a lot of reductions in the ability to reduce capital gains tax payable from the main rates, which themselves have increased. As ever, the government is introducing some anti-forestalling rules in the timings of transactions, and this means that it's not possible to rely upon the usual rules for the timing of a transaction for capital gains tax purposes. There is a special anti-forestalling measure more to patch out those transactions which are not genuine commercial transactions, if you're trying to get advantage of the lower rate. And that could be the lower rate of capital gains tax for a transaction that took place before the rates changed on budget day for gains not covered by business asset disposal relief, or for ahead of the future changes in 2025 and 2026 to business asset disposal relief. The legislation is quite strict. That it's not going to allow transactions which complete after those changes to benefit from the rates before those changes, if the disposal would otherwise be taxed at the earlier point because of when the transaction was unconditionally completed. Now, often hear me talking about, and I've written quite a lot about the usual rules on capital gains tax timing of transactions from the point of view of what tax year the transaction falls into, but this is a slight change to that normal rule. Moving on to inheritance tax, I have been amazed by the amount of people in the media and non-tax community whose knowledge has increased exponentially on inheritance tax in the last few weeks. It's usually tax people like me that have get bothered about these things, but the inheritance tax rates and bans have been frozen for a few years. Rachel Reeves announced that will be extended to April 2030. That will bring more estates into inheritance tax where there's no other reliefs available. Agricultural property relief and business property relief is going to change from April 2026. This has been very controversial. We saw the farmers' protest at Westminster yesterday about this, and the 100% of rate of relief for both APR and BPR will only continue for the first £1 million of value of combined agricultural and business assets, and then a 50% relief will apply thereafter. So there's been much talk about a 20% tax rate, and that 20% tax rate has come about because of the 50% relief against a 40% rate of tax. After the first £1 million, the 50% rate will, however, apply to all shares on the alternative investment market, regardless of the value, so they won't get the £1 million threshold. Now, there's been a lot of speculation ahead of the budget in terms of what inheritance tax changes the Chancellor could have made, and there's been a huge reaction in the weeks since the budget in terms of the changes that she did announce. Now, the first thing that was speculated was that APR and BPR might have disappeared altogether. One possibility might have been that she might have decided to restrict it to only those that are actively farming. In the case of APR, in the farming business, there's been a number of people who have bought farms, or they maybe bought AIM shares purely for the fact that they qualified for agricultural property relief 100% in the case of farms, or business property relief 100% in the case of AIM shares, subject to the other criteria being met. But the Chancellor has decided just to have this £1 million threshold for most assets, but AIM, there's not that there. The changes, although they're coming in April 2026, they will also apply for lifetime transfers on or after budget day, where the individual dies after April 2026. So lots of complications. I've spoken to a number of members in the days after the budget to see what their thoughts are, to see what their clients are saying to them. And I think the important thing is to bear in mind is not to be too quick in reacting to that. There's time to plan to April 2026. It's possible that there might be some changes. I've got no inside knowledge on that, but it's a political decision. So there is time potentially for those rules to change, and sometimes we have seen U-turns happening before. I've not seen any indication of that at the moment, but it is possible that there could be changes before April 2026. So it's a case of watching this space. I certainly would encourage you to talk to your clients about the potential impact it might have. Have a think about if there's going to be an inheritance tax liability that wasn't previously expected. How do you deal with that? Is there an option is it appropriate to accelerate a transfer to the next generation? It may be that your client might have wanted to hand over the family business on death because of the capital gains tax uplift on death, because of the business property relief, or agricultural or business property relief being available for inheritance tax. And it may be that you might instead look to see whether or not, trying to see whether the client is likely to survive 7 years after the gift. So it would be out with the scope of inheritance tax, with the possibility of claiming capital gains tax holdover relief to get round the lifetime capital gains tax that would be payable on the transfer. Lots to think about, lots to talk to clients about. The other area that just adds extra complication to that planning is those clients that have got unused pension funds and death benefits from a pension from April 2027. That will be included in the value of estates. So you might have some clients that both the APR and BPR changes from April 2026, and the pension fund changes from 2027 will affect. So you could have someone who had no inheritance tax liability because it was covered by reliefs, or in the case of pension benefits, covered by out with the value of the estate, moving to a situation that they've got quite a significant liability. The other option, that if planning isn't available, is to consider, well, just to accept the fact that there's going to be an inheritance tax liability, and is it an option for the client to take out some form of life insurance to pay out to cover the inheritance tax liability for those who are left behind. Lots of things that will be on a client by client basis, and certainly anyone who thought their inheritance tax planning was sorted will very much need to revisit that in the weeks and months ahead. The other thing, of course, with these assets coming into the value of the estate in terms of pension fund assets, you could find that the residence null rate band is no longer available because the value of someone's estate has increased, so that gets tapered down, and that in itself might, not only is the pension subject to inheritance tax, but it might affect the inheritance tax exposure of the wider estate because of the changes to the residence null rate band. Moving on to VAT, I don't propose to cover that to any great extent because there's no changes to the VAT rates, and the registration thresholds, which did change recently in previous fiscal events, are remaining unchanged, currently at 90,000 for VAT registration and 88,000 on VAT deregistration. The VAT on private school fees from January 2025 was well expected. It was well covered in the government's manifesto, so it's no surprise that that's came in from January 2025. But when Rachel Reeves stood up in July 2024 to confirm the announcement, that's the date for any prepayments for terms starting on or after 2025 get caught. So any prepayments for school terms starting on or after 1st January 2025 would be caught, even though they're ahead of time. Making tax digital. It's not that long since we had a separate webinar on making tax digital when I hosted HMRC, the HMRC Making Tax Digital team, who talked about how to prepare your practice for mandation in April 2026, when there's a legal requirement for sole traders and landlords with gross income above £50,000. That's been known for some time. What's also been known for some time is in April 2027 that the threshold is going to reduce to £30,000. What is new in this budget is that there is now a direction of travel that sole traders and landlords with gross income above £20,000 will be required to submit quarterly updates under MTD for income tax. I suspect it's likely to be the end of the Parliament rather than near the start of the Parliament, for no other reason than HMRC needs to see how the testing that's going on at the moment with those who have signed up to file quarterly updates before they're legally required to do so, and also to see how that £50,000 population will get there in April 2026. ICAS has made representations and will continue to make representations to HMRC on this, because I think it's really, really important that the larger businesses that are affected by MTD can get to grips with that, and HMRC can see how the systems can work for those businesses before the smaller sole traders and landlords, many of whom at that level might not actually have to pay any tax. But that's the intention, and there's also the commitment that the government has to go ahead with MTD for income tax as planned. We've seen the can kicked down the road a few times now, and there's always been speculation that this is going to be delayed. I am as confident as I can be that April 2026 will go ahead. I have regular meetings with HMRC on this, as David said at the start, and I cannot see HMRC likely to, especially now the government has confirmed its commitment in the budget to go ahead with MTD from April 2026. So hopefully this will give the software companies the confidence they need to design the software solutions to allow businesses and their agents to do that. When it comes to partnership and companies, there's no further developments at the moment. Very much watch this space, and I suspect that HMRC will be looking to see how MTD for the sole traders and landlords goes first before they even consider making any further moves in that direction. Very, very briefly on furnished holiday lets, this was a very, very popular subject. I've spoke to several members on the impact that the rules changing from April next year will have on their clients. We had a very popular webinar with lots of questions back at the end of August on that when the draft legislation was published. And we submitted a response on behalf of our members, highlighting some issues in the draft legislation. Unfortunately, there have been no changes in the draft legislation in the finance bill came through. It's pretty much identical. There is, however, a policy document that's been published and in response to the consultation on the draft legislation, there are many things that's confirmed. For example, that there's no changes to the VAT rules on furnished holiday lettings, and there's no plans to change that, even though the changes for income tax or corporation tax are changing. And there's various other things in there that they've just noted, and that's the comments that the professional bodies have made and either accepted or agreed with them. There's nothing really that major to write home about. There is a policy document on the website. We're looking to HMRC website, looking to do an article on the ICAS website as well, just to flag up what actually is happening in the final version. But capital gains tax, capital allowances, and other benefits will cease from April 2025. If it's a subject that you're particularly interested in, that previous webinar is available for on-demand viewing, so I'd encourage you to have a look at that if you wish. Another thing that changed in the spring budget that there's been an update is the high income child benefit charge. The £50,000 threshold was increased to £60,000 from the 6th of April this year. And there's also a change in the taper rate, so that child benefits only withdrawn once a taxpayer's adjusted net income exceeds the £80,000. Now, in the spring budget, there was a proposal to move from April 2026 to a household system, and the autumn budget has abandoned that proposed move. And I think, aside from the perhaps perception of fairness, from a practical point of view, this is something that ICAS welcomes. We remember the challenges that our members had when it came to the old tax credit system that was based on household income. And it also goes against the concept of independent taxation. The other thing on child benefit that I'll flag is just to make sure that if anyone has any child benefit, it requires child benefit to maintain their national insurance history, there are some changes afoot. We've got an article on icas.com that covers that subject, and just making sure that nobody misses out on their entitlement to state benefits because they haven't claimed child benefit because of the HICPIC position. But the government is aware of that, and it's going to make it easier for people to catch up on national insurance credits if they've been missed. And the last slide for me, other miscellaneous changes, not going to cover these in any great detail. And I think my colleague Susan might be covering some of these in more detail in the webinar we've got in part 2. The HMRC interest rates on unpaid tax is to increase from April 2025 by 1.5%. It's important to bear in mind that there's no change to the interest on overpaid tax, and that is an area that we continually have discussions with HMRC, because we receive a lot of feedback from our members at how their clients' refunds are not being processed in a timely manner. So unfortunately, no changes on the interest on that side, but if the client is due to pay tax, there'll be an extra 1.5% to pay from April 2025. No real incentive to use HMRC as a alternative to a bank. Fuel duty has been frozen. Still, that freeze has been continued, and the temporary 5p cut extended for a further year. The energy profits levy for oil and gas companies is to increase to 38%, and the investment allowance is removed, I beg your pardon, and the levy will be extended to 2030, 31st March 2030. There's a new regime for the non-domiciled taxpayers, a complete change in how they will be subject to tax on their income outside the UK. 100% relief coming in on foreign income and gains for new arrivals for the first 4 years of tax residence. And there will be a rebasing date for foreign assets for capital gains tax purposes of the 5th April 2017. And no decisions despite earlier consultation to strengthen or increase the regulatory framework when it comes to the requirement for those given tax advice to be a member of a professional body. But I think it's a case of watching this space. No decisions have been made at this stage, but we'll await any further developments. And I think that is everything I look to cover at, David, and I'm sure lots of people have got questions. It's been a very popular budget for a high level of interest in all the different changes that are happening. So I'm sure you've been watching them coming in whilst I've been speaking there.
It certainly has, Chris. There's quite a few questions come in, so we'll just rattle through them just now because we are starting to run out of time a little bit. But Justine, perhaps we could come to you first of all, just on the employer NIC changes and such like. Couple of questions really relating to the lower earnings limit and whether the drop in the secondary threshold has an impact on the lower earnings limit, which gives that side of things, and also whether you need to register payrolls as soon as someone earns 5,000 or more rather than the lower earnings limit.
Yes, thank you, David. Just took myself off mute there. Yes, absolutely. As far as I'm aware, I've been out and about this week, so I haven't actually checked the guidance, but the guidance from on gov.uk to register as an employer, as far as I'm aware, it hasn't been changed at all. But their advice is and has technically always been to register as an employer as soon as you start paying anybody. So actually the levels of thresholds and whatnot don't necessarily come into it. However, I know that in practice people tend to leave it until there is actually something to pay over, which is okay. It's just that the government wants people to register as an employer so that they can collect statistics on who's employing people and how many people are employing, even if they're not actually eligible to pay any income tax or national insurance. So yes, keep scanning the sort of gov.uk pages as to how to register as an employer. I think at some point some real-time information guidance will need to be changed, but as I say, I don't know whether it has been changed yet or not, but something will have to change at some point.
That's great, brilliant. Just moving on to the double cab pickup situation, such like be a few questions really just around the VAT situation. I mean, obviously the benefit in kind definition and the VAT definition is now out of kilter a bit. So the question, I guess, is basically what's the VAT position, and can input VAT still be reclaimed on double cab pickups?
Yes. Yes.
Nothing's changed.
Nothing's changed. As long as it's being used for business, you can reclaim.
Yeah.
So, yeah.
Brilliant.
I think it's the same, David, as what's happened with the furnished holiday lets position, is that there's a change on other taxes, but there's no change to the VAT position.
VAT. Yeah.
So there's no changes to that at this moment. It may be that changes at a later date, but certainly previously those thresholds for double cabs were aligned for the different tax purposes, but that they won't be going forward.
Yep. Okay. And Chris, as you can imagine, a few questions in relation to the agricultural IHT position and such like. So first question is, how does the gift with reservation of benefit rules come into play if a farmer gifts their share of the business or the farm but continues to farm?
That's a very good point. It's probably something that's maybe a webinar in itself, and I think we maybe need to actually look at the broader aspects of farming. But yeah, that quite often, if someone is looking to pass the farm on to the next generation, they would just retire, and possibly those issues will be less of an issue. But it's actually, you're very right to look at that as a possible area. And this is the thing that previously, when it was covered by agricultural property relief and/or business property relief, family farm didn't need to worry about these things.
Yep.
And these are the types of conversations and structures and the timing of events that our members are going to need to look at when they're discussing how they will impact on their clients, with clients and other advisors.
Yep.
It's going to be very, very much a team effort between the accountant, the legal advisors, and the client to find the right solution for them.
Yep, absolutely. And the next question might fall into a similar sort of category with that as well. I guess it's been talking about the press, lots of stuff in the press, and that typically, according to the government, if a husband and wife farmers, they have £3 million of the estate before any IHT being due. The question is whether the residence nil rate band is still available if the farmhouse is owned by a farming partnership, as is often the case in Scotland. Again, that may well be something that we need to take away and
yeah, I mean,
I
don't see that these changes affect the application of the residence nil rate band. I mean, whoever's asked the question is right to flag that it gets tapered, and that's where that £3 million figure comes in, because they on second death, if everything's left the surviving spouse, you have 2 lots in residence nil rate, so that's where the first million comes in, and then each person would have had £1 million. Where there's been a little bit of lack of clarity is how many times you can count the £1 million, and that's something that we're going to watch this space and have dialogue with HMRC as need be for guidance on that.
Yeah. Okay.
But yeah.
And
never
just
dull
what?
moments.
Absolutely. As you say, the legislation's still going through, so there's possibilities of changes and questions that need to be asked there as well. Just one final question. You mentioned in terms of the changes to pensions and IHT as well. The questioner in this case has highlighted that there could be significant tax rates in relation to some of those, some well in excess of 90% in certain circumstances. And I guess so. The question there is really, do you think the government has really thought this through, and is there chances of amendments, as legislation passes its way through Parliament?
That's a really good question, and I have seen lots of people on LinkedIn and other platforms coming up with lots of unintended consequences, perhaps, of the legislation. I would have thought that the government would not have expected that level of a tax rate to have kicked in, but as ever, the mixture and the interaction of different changes that have been announced to inheritance tax might give quite high marginal rates.
Yeah.
And whether they fully thought that through is probably a question for them. And I think, given all the reaction, I would certainly think that it is possible that things could change. There's no indication of that at the moment, but it's certainly not with the realms of possibility, given the reaction that the inheritance tax unions in particular have had as they've came out, and as people have started to understand how they'll affect them and their family.
Absolutely, Chris. I'm quite sure you're right that there'll be lots of debate in the weeks and months ahead. But for just now, Chris, Justine, thank you very much for your insight. If anyone does, of course, want to pick up with us later on, we can do so separately outside the webinar. but we do need to start drawing things to a close just now. As I say, if anyone does want to pick up anything in particular with us, then we do have the technical help desk, which is available through the contact us area on icast.com. And in general, just in terms of keeping up to date with further information and guidance, do always keep up to date through the ICAST website, and link in with us on LinkedIn and X as well. Before we finish, it's always important to get your feedback. So we are going to launch a quick poll just now. If you're able to please do that, as again, occasionally that won't pop up for some people, depending upon your own policies. But while you're doing that, looking ahead, I just want to highlight 2 or 3 events that are coming up. As I mentioned, this is the first of 3 autumn tax updates. Next Tuesday, the 26th of November, Susan Cattell will be back alongside me as we look at some developments out with OMB and employment taxes as part of a general tax update. And then on the 12th of December, shortly after the Scottish budget that Justine mentioned on the 4th of December, Justine and Chris will be back with the final part of the Autumn Tax Update series when we look at the developments in the area of devolved taxes. And if you do happen to be in or around the south of England, you may also be interested in signing up for an event which is being hosted by HMRC in their Croydon office, when they're bringing together agents and software developers to help you get ready for MTD for ITSA that Chris mentioned, and when it becomes a legal requirement in April 2026. You can sign up to all of those events through icast.com/events. Well, it does only leave me to thank you, the audience, for joining us today on the webinar. I hope it has been helpful to you, and until the next time, goodbye.